it could be a messy type of year where you have these upswings and downswings, feast or famine.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with market analyst and former hedge funder Thomas Thornton. If you haven't yet watched part 1 of this discussion with Tom, in which he explains why he sees more economic pain ahead, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Tom also kindly shares the details of what's currently in his portfolio. And you'll want to hear it, as despite the bruising losses the markets took in 2022, Tom's own portfolio managed to produce a gain of 53% last year. All right, let's get started watching part 2 of our interview with Thomas Thornton. I do want to shift to the market side of things. What do you expect the markets to do from here? We talked at the very beginning of the interview about how you think they're, I can't remember the word you picked. Was it absurd or something like that in terms of the disconnect between current prices and the macro data? But what kind of year are you expecting in the markets?
I wouldn't, there's a lot of people that have these year-end price targets, and, all the strategists on the street have price targets. The main strategists were like 3,800 to 4,200. So they were in this tight range. I really don't care what the end of the year looks like, because it could be a messy type of year where you have these upswings and downswings, feast or famine. And so I think that earnings are going to be really important for Q1. If we run up into earnings, this market just continues to run up into the March meeting, that maybe the Fed will do 50 basis points. I think I read today that the hikes in May are pretty much going to happen. Look, the market's running higher when Powell is trying to tell people that we're going to continue to raise rates until inflation is at 2%. It just makes no sense to me that people are fighting the Fed aggressively by buying stocks, which I get. Sometimes you just have to hold your nose and buy. But the risk is that those earnings come down. We create another bubble. I mean, the Fed, I skew off something real quick. The Fed is great at fixing the problems that they created by fixing other problems that they created. And we're in this endless loop of that, where they're fighting inflation. That's their job, their mandate. But they basically, with their stimulus of $4 trillion and all the other stuff that they did, lowering rates, they created another bubble. And now they're fixing inflation, and they're diligent about it. I just think that in many respects, if the Fed just stopped raising rates and said nothing, they talk too much as well. They're constantly talking. If they just stopped raising rates and the market was just left there saying, okay, well, what are we going to do? Then I think the markets would probably price themselves into a more rational market. But it's always the hope that the Fed's going to be there. And look, we're conditioned to it as people that have been in the markets for 30 years. We're conditioned to watching what the Fed does or what they might do next. And I'm sort of blown away by sort of reading my screens over here. Basically, someone just said "F your puts." That was somebody in my chat room. Someone said nothing. He really said nothing to the point. But basically, people are thinking that he remains the same, is dovish. And maybe he knows some news that we don't know. But I think the Fed just makes it up as they go. And that, that's it. The Fed makes it up. Okay, I'm going to just say it right there. They make it up as they go. They'd rather have the markets going up because there's less political flack on them, and they don't want to cause a depression. Okay, but again, inflation's going to stay higher. Consumers' bank balance sheets are going to decline. And then what's going to happen? It becomes more of a crash scenario for a lot of people. And trust me, anybody that loses their job, and then they can't find new jobs, that for them is a hard landing.
That's a hard landing right there. Exactly. Yeah. And yeah, I talk about that a lot. Is at the end of the day, it doesn't matter what the economists are dickering about the official definition of a recession. It's there when you are afraid of losing your job or you lose your job, right?
And I've been there. I've been through cycles. I've had firms go up and I've had firms go down, and I've had, I back in 2001 at the tech bubble burst, the firm I worked for laid off 3/4 of the firm, and certainly not easy to handle. And when you have high inflation, it makes it even harder to feed your family and find a new job, because the jobs are I think companies are hoarding workers right now, and until they need to start to lay off people, and we're not talking, Meta, they had a bloated
Right.
amount of employees, but it's when just the people that you go to stores, your local restaurant, you start to see fewer people there. That's when things really start to get, they hit home.
Yeah, and I track layoffs pretty closely, and initially people were trying to be dismissive of, oh, it's just big tech, it's those bloated Silicon Valley companies, right? But the contagion is really spreading into a number of different other non-tech verticals, categories, sectors now. Yeah, like you said, like that's the game changer, is when people are obviously it's a game changer when they lose their income because they can't buy stuff, right? But also it's when they're afraid of losing their income is when people start tightening their purse strings. And because the economy is so driven, consumer spending driven, that fear has a big impact in and of itself, that negative wealth effect.
So then we go back to the whole demand issue.
Right.
This is going to be a clean quarter. You have basically it's a perfect scenario. You have the markets are going up. You have unemployment at record lows. You have liquidity in the system. But is the consumer going to slow down and not buy an iPhone, not buy a Tesla? And are those companies what for example, Amazon Web Services, they're brilliant company. It's the core of Amazon, and it's where they make their money. A year ago, they were growing at 40%. They just reported a big downtick this quarter, and projected next quarter, this quarter we're in now, will grow at only 20%. So that's a big deceleration. And what happens after the quarter after this? Are they going to say they're going to grow in the mid-teens? And maybe mid-teens is still great for companies, but those companies are going to, they have so many different clients and so many different websites that they handle. And it's a great indicator, by the way, that if those companies are pulling back on AWS services, then I think that's a big problem that's across the board on websites out there. I mean, I have a website. I use Amazon Web Services, but if people start to pull back there, that could be a big tell for the economy. So that's one that I'm really watching.
That's an interesting indicator. Okay, that's great. Well, okay, so you don't get to go to war with the markets you wish you had. You go to the war with the markets that you have, right? So how are you approaching allocating in this environment? Like, what's your approach?
Well, one of the things that I show on, hedge fund telemetry, I have a model portfolio. It's every trade that I do is reported on one of 3 notes that goes out every day, and they're all tracked. The winners and the losers and even the stinkers are in there. But I have I have parameters that I try to stress to people what to do. I don't go over 5% on any initial allocation. I try to keep my sizing restrained. I think one of the best ways to lose money is to have too large of a position in something that's not working. The other thing is I like to keep my anxiety levels down. So if I have a 5% position in something or a 2% position in something and it's going against me, it's not going to necessarily kill me. It's not going to change my day, week, month, or year. So that's what I'm doing. I'm trying to stay very diversified, and I'm currently net short 30%, and I have a fair amount of cash on top of that. I mean, 30% net short of what I currently have. I have a couple of value ideas in there that are as longs. I like Paramount, which it's the cheapest of any media company. They do have some growth issues. They're spending a lot of money on their content. I think there's a lot of low-hanging fruit that they can harvest there. I like Verizon as much as it may be the most boring stock, but if you get a return of 5-6% and they have a 5% or 4.5% return on their yield, that's not so bad. So I like that. And people tend to pay their phone bills first,
Right?
and because they've got to stay connected to their Twitter and TikTok, and
They got to watch their
Instagram.
Wealthion videos. I mean, come on.
That as well. But then again, we're seeing one other thing that's a little concerning is that we're seeing repossession rates go up on cars. So we're starting to see that in the consumer place. That starts to hit, and then that moves into housing down the road. So I have some housing shorts that I mentioned. I'm short Tesla. They're a little car company. I did take a lot off lower. My average is 100 points higher than where it is now. I took the majority of it off lower. I know the stock pretty well. It does crazy, stupid things and goes up. And I avoided a lot of the upside in my face action. And I probably will add to it, because that's one of the companies that I think will have a demand problem, even as they have lowered prices, which includes a margin problem. So I have that.
And I'm just curious, because we're going to get comments from the Tesla folks.
Oh, hi,
Super
Tesla
quick.
folks. It's not personal.
Yep.
It's technical.
Yeah, problem is with Tesla folks, it's always personal. But just real quick, since you mentioned it, in a nutshell, why do you expect a demand problem there? Or do you mean demand, like we were talking earlier, just a consumer affordability, they could be able to afford less?
Look, it goes into the higher rates, makes it harder to buy cars. They have a very tired fleet of cars that they haven't made any changes to for a while. China's reopened, and the China data from December to January was better. But if you look at from November to January, the data is actually down. That's with huge price cuts. And it's that in itself. They have 2 new factories that are coming online. So they're not going to have a supply issue. Their supply chains are reopened. So there's going to be a lot of cars to buy, and they're not necessarily cheap. A lot of them some of them are going to get the benefit of the tax credit that's out there, but you've got to jump through a bunch of hoops and make less than $150,000 to buy a $50,000 car. It's a stretch. But look, I could be wrong. Stock is one that just has a crazy mentality to it.
Yeah, that's fine. I didn't want to rattle on Tesla. You could talk about it forever.
I don't want to. It's just sort of the bane of my existence. I'm short Coinbase. I'm just looking at my portfolio here. I'm short Coinbase, and I just added it back a few days back. And I think their earnings are going to be weak next, or when they come out. I think they're out next week. And just because the entire quarter that they just had, crypto went nowhere, and we just had like a nice bounce. And I don't know if that's necessarily reinvigorated the crypto people, but I think it comes down to transactions, and I just think that I don't think and this was when I was short a while ago, and I covered this one in a lot lower. I mean, 50% lower recently, and it's just spiked up. So I'll take advantage of the timing on these and cover low and sell short high. On the long side, I like Disney. They report this week. I think that the company could surprise, and I like that there's an activist investor involved, that Disney's resisting. And if you go back to the Procter and Gamble scenario with Nelson Peltz, he tried to become he was an activist in Procter and Gamble. They resisted, and he got on the board. They instituted his changes, and the stock went crazy on the upside. And ultimately, when Nelson Peltz resigned from the board, the CEO said he was absolutely fantastic. And I know some people that are good friends with him. He's a tough cookie, but he's very, very good. He's a very good operator. So I think Disney has a lot of, I like media companies, as you can kind of tell.
I can tell, yeah.
I was a media trader at one point in my career. So I like Disney on the long side. I'm long Ford, and that's been actually, I bought that lower, and that's actually been a sort of a pair trade with Tesla. So I'm up 16% in that, and offset some of the small amount of Tesla that I have short. It's done okay. I was long Lucid, by the way, at the lows, and I made like 20% on it. And this was right before the stock went, crazy on some rumor. And I got out of it. I was like, oh, that would have been nice. But sometimes I will see some of the indicators that I use and hold my nose and pair off something against another idea. And so that offsets some of the Tesla lift as well. I'm short gold, which is probably not very popular with people, but I think the dollar could go up from here.
Is that why you're shorting gold, as a response trade to a stronger dollar?
Yeah, I mean, I think the dollar could go. I think the dollar could go up from here. I have a lot of indicators that are telling me that, and I'm short home builders.
Do you mind, only because you mentioned them earlier, do you mind sharing those two ETFs, the home builder ETFs that you're short?
Yeah, ITB and XHB, and they're mostly the same, but one of them, I forget which one, has Home Depot and Lowe's and Williams Sonoma and other suppliers, Sherwin-Williams and Masco and Mohawk. Those those companies have also seen contraction in their business as well. So if people are buying less paint, I mean, I think Home Depot is probably a good one to watch, because generally the spring season, there's a lot of new houses sold. And when you buy a new house, you go to Home Depot and you fill up your basket twice with everything you need, from mops to brooms to light bulbs to batteries and all the other stuff that you need for a new home. So if the housing market doesn't really turn over, I think that's going to be that'll be a risk in the spring. So I'm not short Home Depot, but I'm just doing it with the ETFs. I don't really have major conviction overall in the market right now. There's times where I get really, really bulled up, and that's when people are like, Tom, are you feeling okay? Because it looks like it's coming to the end of the world. And then there's times where I get really bared up, and I'm sort of neutral, leaning more bearish right now.
Okay. Well, Tom, look, thank you so much for being so generous and transparent with us. You've given our viewers a lot of different positions to go research. And I do remember talking to you last time when you were in the middle of your success in 2022. And just to remind folks, Tom's portfolio was up 53% last year. I remember you crediting at the time saying it was position sizing that was just a huge part of your success there. Does that remain true here?
Yeah. Again, I traded a lot more last year because we added a third note, mid-morning note. And there were times where I'd get really bulled up, and I'd buy 20 longs. And then there were times where I had 20 shorts, and I try to have some longs and shorts at the same time. But I will say, people say, well, did you have one that stood out as a big winner? Well, I had some that were really big percentage winners, but I never had anything that was just like that. Tesla, for example, contributed 6% to my gain last year, and that was a big winner on the short side. So I keep it diversified. I think there's a way of keeping your size small and just grinding it out every day. And it's not a day trader type thing, but it more swing trading. And sometimes trades can last a little longer, and I have a few that are longer term in nature. But yeah, that's not going to happen this year. I think if I can squeeze out 20%, I'd be thrilled. That would be, better than my expectations. I mean, I don't walk on water. I post all my wins and losses on the site, and even the worst ones. And I'll say this: I like to, and this may sound funny to some people, but I like to take losses. It clears my head, and I don't have to think about them anymore. And keeping size small, I'm able to not have to take. It's not going to be debilitating to me. I'm not going to be
Right.
Upset, and I think that's just how I operate it. And again, it's a long year. There's gonna be a lot of different swings. I'll change my mind quite often, long side, short side.
All right. Well, look, Tom, you're welcome to come back on the program anytime this year to share your updated
I'll
viewpoint.
call you. I'll call you when I get really bullish. Okay.
Anytime you want. We'd love to have you on here. And it's so valuable, I think, for the audience here to see how, you're not managing others' money these days, but you're showing how a professional, experienced hedge funder thinks, right? And how they approach investing and how their mind works. And that's not something the average investor gets insight into every day. So it's super valuable. So anytime you want to come on to share it.
Yeah, I have capital of mine and a couple friends that I help them out with. So that's one thing. I have no plans on running an ETF or launching a new hedge fund. It's more hassle. Done it, been there, done that, and
I get it, and I'm sure there's people here who would love to give you their money even to get a 20% return this year. And I say even because I'm comparing it to your return last year.
Past performance is no guarantee for future results, and
it's not. But where I'm going with this is the last question I always ask is, where can people go to learn more about you and your work? And for people that want to continue to see what's inside your brain, the good news is they can go subscribe to your newsletter. So where should they go?
Okay. And I want to say thank you. Last time I was on, I met a lot of your subscribers who became my subscribers. So that was very nice. And I think it was some really solid people that are following you. So my site,
good synergy, but thank you.
Yeah, I enjoy chatting with you. My site is called Hedge Fund Telemetry, and Hedge Fund Telemetry, we offer couple different price points, but I gave a discount last time. I don't even have a discount really out there, but I'll make one for you guys. If you use the code markets with an S, I'll give a $250 off our annual rate of $750 for the first year annual rate, and so it's $500, and you get three notes a day, a little bit of my humor. We track market sentiment, all the good stuff, and but I'm happy to answer questions if people want to email as well, so they can find me online. I'm on Twitter too.
And give us your Twitter handle.
It's Tommy, Tommy Thornton, Thornton, and occasionally I'll tweet a lot about cars and Formula One, and not really food anymore because I don't like doing that, but I have a lot of market stuff on there. That's what
All
I
right,
do.
great. Well, look, Tom, when we edit this, we'll put up the URLs to your website, the discount code, your Twitter handle. And I will say, as somebody who gets your updates throughout the day, I find it super useful to me in terms of not just keeping track on what the market's doing during the day, but seeing it through your eyes in terms of what catches your attention. So I find that a really valuable service. Tom, it has just been a joy having you on this program again. Thanks for coming on. Thanks for sharing so much detail with us and being so generous with your time.
Well, thanks, Adam, for having me on. Always great questions, really informed questions that hopefully my answers enlightened a few people and sparked some interest. And I really appreciate it. You have great subscribers, and congrats to you. I should probably come to your conference, and maybe I could be like a bull and like say Doomberg. I can go back and forth with Doomberg. I mean, I want to meet him. Does he look like the bird? Little.
You want to make that happen? Exactly. Yeah. Green beak, everything. Yeah.
Okay.
Look, to the extent you're interested in that, Tom, we can absolutely make that happen. That might actually be a great video here, folks. If you want to see a Tom and Doomberg video on this channel, let us know in the comment section below. If there's enough interest, we'll definitely make that happen. But Tom, it's a mutual admiration society. Thank you so much. Huge fan of your work. And like I said, you're welcome to come back on this channel anytime you want to. All right. Well, look, Tom, thanks so much. Everybody else, thanks so much for watching. Well, all right. Well, now's the time on the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Wealthion, to both comment on what Tom just said, but also remark on what the markets have been up to since last week. I'm joined as usual by lead partners John Lodra and Mike Preston. Hey guys, Mike, why don't we start with you? What were some of your key takeaways from the discussion here with Tom?
Sure, I really enjoyed it, Adam. I'm just looking at my notes here. I really liked Tom's demeanor, his humility. I mean, this man has produced wonderful results. As you had mentioned last year, 53%. He's really humble about that and says past performance isn't a guarantee of future results. He's right about that, but he's done very well and should be proud. And his humility and calm demeanor shines through. And I really enjoyed that. It's not a business that's always easy to be calm about. It's sometimes difficult. So I admire him for that. He says that the Fed or the market doesn't believe the Fed. And the Fed's playing a game of chicken with the market. I think that's probably true. Just looking at what the market looks like or watching the tape, it seems like investors are just dying to catch every little turn. This is a market that spikes up repeatedly and then tends to fade, it seems. Lately, it's been fading. Today, as we're recording here on Thursday, the market had a really strong open and it's fading today. And one day doesn't really mean anything, but it's been a lot of volatility and everyone's trying to catch the turn. And I believe it remains a dangerous market. Tom says that he thinks we might be in a range of 3,500 to 4,400. I mostly agree with that. I think that we might see a little bit lower, maybe down to about 3,200. But this is a market that really it seems like it wants to go up. A lot of the indicators are bullish, yet it doesn't really seem to be putting in that upside breakout, or the upside breakout that looks like it happened last week. It's just kind of been going sideways here for a while. So we'll see what happens. But I believe there's significant risk to the downside, and many participants in this market will feel a lot of pain, even if we go down to 35 or 3,700. He says that there's some things that are deeply oversold. Natural gas. We've been watching a chart of that. Natural gas went from about 10 per million BTU to about almost to 2. It's a huge drop, natural gas. So he says he's long natural gas. We don't have any plays there, but it's something that we've been keeping our eye on lately. That's a big move. And he talked a little bit about his model portfolio, some of which we agree with and some of which we don't. I found it fascinating, though, that he talks about he likes to not worry too much about positions, and his maximum position size is about 5%. I think that's good advice for most investors if they want to sleep at night. He's about 30% net short right now. We at New Harbor are not net short, but we're not very long either. We're only about maybe 10 or 15% net long. So his bias certainly seems to be to the downside. I think we would agree with that. We agree with his value bias towards things that are beaten down or companies that are beaten down. He mentions a handful of names in his talk. We think you'll do better with value plays if and when the market does take another tumble. And so lastly, to recap, the market's had a really strong start to the year. The NASDAQ is still up, I guess, around 13%. Year to date, the S&P over 7%, and even the Dow is up 2.4% or something year to date. And the Dow is only maybe 8% off of its all-time high. That all-time high back in November or November of 21 or January of 22, depending upon which index you're looking at, it's been a very controlled decline. There's been no panic. And this bear market that we think we are in is over a year old already. And so there's a saying out there that says the bigger the top, the bigger the drop. This is in contrast to being a healthy pullback that we think is going to jump to new highs. We think this is just a large topping process over the last year or so. So we're doing some things, but we're very lightly exposed. We still have a good amount of cash, and I'll stop there. But overall, I really enjoyed this talk.
All right. Yeah. When I turned off the camera, Tom and I talked for a bit, and he really said this is really sort of a trader's market, right? So, Mike, as you said, he sort of expects stocks to trade largely in a range for the rest of this year. And he says for him, that's actually like perfection. That's the market he loves to have, because he can sort of tell by his indicators when things are getting toppy, go more net short, ride the shorts down, go long again, and just make money, each direction when the market moves. I know a lot easier said than done, but for him, he says that's what his particular style works really well for. And just for the folks who say, oh, everybody you bring on Wealthion is bearish, they're not picked because they are, quote, bears. They're picked because they are data driven, and most people are looking at the data today and saying, hard for me to be super optimistic. I will say, with the way that Tom described himself was a perma opportunist. He said, look, in a range bound market like this, I can find ways to make money on the upside and the downside. And that's all I focused on. Right. So I just think there's a lot of opportunity in the market that's coming from here. I also want to note too, that you mentioned, he mentioned some value longs that he liked. One of them was Disney. That popped 6% this morning. So I hope Tom took some profits on that, not only because it popped like that, but also, to your point, Mike, it has faded along with the market today. I think it's only up about 1.75% or something now, right? So those type of signs tend to be indicators of when a market's getting toppy, when it's been jumping and then it keeps trying to jump, but it just can't get higher on any permanent level. And that's when things sort of tend to roll over again, at least in the short cycle. So, all right. John, anything that you want to add to Mike's observations about Tom's stuff in general before we talk about his allocation?
No, really. I think Mike did an excellent job summarizing Tom's comments. I liked his talk for many of the same reasons. I would just emphasize the position size comment he made. We totally agree with that. In fact, many of the conversations we're having lately with prospective clients that come to us for a consultation, many of them have large, holdings, like legacy holdings in say some individual stocks, some of the darlings over the last, decade, the Apples, the Teslas, the Googles, whatever. They're enamored by those stocks, and they have done very well. And in many cases, they have large capital gains embedded in them. But again, position sizes are, even if you still are very bullish on a given stock, you want to be very mindful of position sizes. So, we, for example, for some of these clients have counseled them to, smartly book some gains, using losses if possible to offset those. But we can also hedge positions to effectively reduce the position size to a more manageable risk parameter for a client. I also would like to emphasize that we agree that one need not fear markets that are choppy or range bound or up and down. In fact, a more tactical strategy is really meant to exploit that, not with precision or perfection, but with success in that kind of market. If you look at the late 60s through the early 80s, for example, the market went pretty much nowhere. In fact, lost money on an inflation-adjusted basis, but there was tremendous amount of volatility along that ride that, a more tactical investor, you didn't have to catch all the ups and you didn't have to miss all the downs. Just catching some of the ups, half the ups, and missing 60% of the downs was enough to do very, very well over that time period, which a passive investment would have been very poor. So our style and our approach, we use options, for example, where we can bring in income to help buffer out some of the volatility and tactically shifting between things like short-term T-bills and equities on short-term trades and things like that. We think that's an environment that we likewise don't dread. In fact, we kind of look forward to it in terms of being able to employ some of the skills and the tools that we have.
Great. Okay. Yeah. And hedging, super important just from a portfolio insurance standpoint. But like you said, John, if there's a period where you think it's going to ebb and flow, the hedges can keep you from losing money during the flows, right? So Mike, I'll come to you with this question around hedging. So a point of potential differentiation between Tom's outlook and yours at New Harbor is he is short gold right now, where I think you guys are still long in your exposure to precious metals. He said basically he's short right now because he expects the dollar to strengthen from here. And I don't think you guys necessarily think the dollar might not strengthen. We just did our monthly Q&A on Monday, and I think you guys said, yeah, you're totally open to that potential. So if you could explain maybe two things. One, why you're still willing to remain long during this period where a guy like Tom is short. And then second, I'm presuming being long, you're relying on hedges that in case the dollar does strengthen and gold does go down as a result, and those are two ifs, you've got protection to the downside because of those hedges.
Yeah, I heard Tom say that he's short gold, and I cringed a little bit, maybe because I want gold to go up, obviously. But we do our best not to data mine here, and I think that Tom could very well be right. Disappointed to see the 2-day drop in gold after Jerome Powell spoke. Yeah, that's what it was. I'm trying to think of what day it was. It was last week, just after the decision. Basically, gold dropped almost $100 in 2 days and wiped out most of the year's gains. That was pretty disheartening. And yes, we also think that the dollar might strengthen. The chart pattern is supportive of that. The dollar might strengthen. Gold is not always inversely correlated, so we can't rely on that. We don't want to get out of our gold position just because we might be short-term bullish on the dollar. So I'll say this from a chart perspective, gold is still intact. It's above the 1820 kind of pivot point that we've been talking about for a while. It looks to be at around 1885 or so right now. And so, while the short-term pullback is disheartening, it's still solidly above the level that we think it looks technically good. Secondly, we have a fundamental component, a fundamental belief about gold here at New Harbor, as many of our clients do, that maybe Tom doesn't share. Gold is kind of like the anti-central banking asset. It gets you out of the system, so to speak. We have long recommended a 5 to 10% position of your investable assets in gold and silver as almost a set it and forget it piece. Now, there's lots of short-term gyrations, but this is a fundamental belief we have in bullion. And we want people to kind of have that and just put it aside. I think the longer chart patterns are supportive of $2,500 gold or so. Short term, things are a little more iffy after last week's drop. That's for sure. As far as the bullion position goes, we're not really hedging that piece or telling people to hedge that piece. We're telling them to just buy it and put it in a safe or put it in a safe deposit box. The gold mining position in our portfolio is a different story. We have 10%. We have a 10% position in gold mining stocks in our portfolio. You can look at something like GDX as an example of the gold mining space. So GDX is hovering right around 30 right now after bouncing up to maybe 33 or so. We think that gold mining stocks offer even better potential longer term than bullion in terms of percentage appreciation, but also they're riskier. They're much more volatile. The chart pattern on gold stocks still looks good, although the pullback is again a little bit disheartening. But on this position, we want to be able to hold it long term. We think the gold's going to 2,500 or above. We think that GDX is going to $55 a share or so or above long term. But short term, it is highly correlated with the S&P 500. So we want to use hedges on that position. And it's hard to describe exactly what that looks like. But I'm just taking I'll pull up this chart here very quickly while I'm going through it. And I'll show you that the collar that we presently have on. And we do, continue to monitor this collar. We do continue to change it from time to time. But here's GDX, a daily chart of GDX. And on this position, we have sold calls up at 35. And we use that money to buy puts down at 27. This is our current collar. This actually expires pretty soon, next week at February expiration. So we'll be adjusting this soon. So all you can do with a collar is put a ceiling and a floor on the position. It's not perfect. For instance, if GDX were to roll over and crash, you would still have some losses between the present price and the floor. But what it allows us to do is hold through what could likely be big downside moves. And there's been many of them. Back here during the COVID drop, for instance, we had a collar on. And right now we have this collar on that I'm going to go back to the daily chart and show you. So the problem with hedging is that it's expensive. If you were to just buy puts over and over and over again on GDX, you'd be spending close to 10 to 15% of the cost of the position every single year. So you have to be careful. We don't always have a collar on the entire position. Right now, we have a collar only on half the position. That's what we feel comfortable with in terms of protection. And we will adjust this. Now, unfortunately, with this pullback, we're going to have to adjust it and maybe move the price even down a little bit on the next collar. We'll see. We were hoping we would get a continued move higher, and then we can continue to increase this collar higher and higher over time. But at best, all we're trying to do is not pay net money out for our insurance, and we want to have crash protection. That's probably the best way that I can explain what we're doing here.
That's really useful. Thank you for showing that on the chart. This is one of those instances where a picture is worth 1,000 words. All right. Well, thanks. That was super helpful, Mike. John, I'm going to come back to you, and then we're going to wrap things up. Another thing that Tom mentioned on the short side, I'd just love to get your quick opinion on, is the fact that he's short a couple of housing ETFs. And we talked briefly about, the really pretty grim housing data, especially house building data right now with all the cancellations and everything like that. And yet a number of these stocks are trading near their all-time highs. So as Tom and I talked about, like they either know something the rest of us don't, or they're just setting themselves up potentially for a big, massive downdraft. Do you guys have any sort of opinion from your perch there at New Harbor?
Yeah, I'd like to comment on it. First, I just want to make a couple quick reinforcing comments on Mike's great discussion of our view on gold. Fundamentally, we like the gold mining companies as an investment, because even relative to the current price of gold, they're still very discounted values relative to their historical norms. So that position or that sector as investing in the companies themselves need not require a massive move higher in gold. Even at current gold prices, we think they're undervalued. And there's some recent consolidation news. I forget the actual headline. A couple of days ago, big gold miner, Mike.
I know that Newmont just bought another
Yes.
mine. I can't remember the mine they bought, but yeah.
So that's usually a pretty bullish sign when there's kind of some consolidation moves, from a management standpoint, anyways. So there's that. And I also we do have actually a small slice of a position that touches natural gas and a whole bunch of other commodities. We do have a broad-based commodity slice in our client portfolios that has a little bit in natural gas via broader energy, but also covers things like agricultural commodities, some industrial metals like copper and zinc and things like that. So just want to make that one quick clarification. But yeah, the housing home building stocks are quite a conundrum to us, because we see nationwide data that really speaks to trouble in the housing sector. Record cancellations, I think either last quarter or in December, for example. Certainly the interest rate moves and the relative resiliency of housing prices so far has not really rippled through, in our opinion, in the housing market. And I know there are a lot of folks out there that have been waiting to make a home purchase on the hope or expectation that housing prices will come down. We think they will still yet fall further, broadly speaking. Certain local geographies, all bets are off. There could be, I just read an article that the suburbs of New York City, for example, have rampant demand still for houses. I spoke to a client who's a home builder up here in New England, and his business is very strong. Because locally there's certain demographical demands that maybe buck the trend of a nationwide housing situation. But broadly speaking, we're confounded at the strength that the home building stocks. If you just look at XHB, for example, which is a sector that holds a bunch of home builders, got as low as $50 a share mid last year, and it popped up to over 70. And this is all in an environment where interest rates have been rising, unemployment, employment, data is starting to look a little bit, less rosy, even though it's still, headline robust. So yeah, I mean, that's not our style. We're not short sellers like he is, and his style is really long short. Hedge fund type of. We don't do that. Most of our clients don't want that, and probably couldn't stand the ride of that kind of strategy for at least the entirety of their portfolio. But yeah, I mean, it seems like fundamentally a pretty sound short position here, but very, very confusing to us, frankly, what's going on in that sector.
All right. Well, we'll be watching it closely. I've got those two ETFs that Tom mentioned, ITB and XHB, on my radar now. All right, guys. Well, look, thanks so much for yet another week of breaking down what's going on. We're going to have to end it there. I do want to let folks know real quick that the early bird pricing is still in effect for Wealthion's upcoming online conference on March 18th. It's a Saturday. Reminder, if you can't watch the event live, don't worry. Everybody who registers is going to get a replay video of all the presentations and all the Q&A. If you haven't checked out the conference yet, just go to wealthion.com/conference. You'll get all the details, and you can register to lock in that early bird price as well. Real quick though, if you haven't heard me dial through them, faculty includes, let's see here if I can get this right from memory. We've got Lacey Hunt delivering the keynote. We've got Mark Faber. We've got Michael Pinto, Danielle DiMartino Booth, Stephanie Pomboy, Rick Rule, Doomberg talking about energy, Nick Jurley talking about the housing market, Craig Wishner talking about investing in farmland, Mike Maloney talking about precious metals, Lucky Lopez giving an update on where the auto market is going to be for the rest of the year. We got one or two other folks. Jeff Clark just signed on to give a mining stock update. So one or two more people we're still pulling into that orbit, but a fantastic gathering of great domain experts. Hope to see you at that conference. And then, Tom runs a very specific type of shop, and he doesn't manage capital himself. He manages his capital privately, but he doesn't manage capital for others. But if you are, interested in like looking inside Tom's mind, you can subscribe to his newsletter and, find out the picks that he is making his portfolio and try to include some of those in yours. Just a reminder, Tom was offering a discount code to Wealthion viewers. So if you go to his website, hedgefundtelemetry.com, and you enter in the code markets, you'll get a discount to his service. But for most people, trading like a hedge funder it's a tall order. And so we highly recommend that you work under the guidance of a professional financial advisor who can take into account all the macro issues that Tom and I talked about, but then actually translate them into a personalized plan for you, your particular situation, your goals, your risk tolerance, et cetera. And then actually help you execute upon that plan, because most people, don't have the experience and quite honestly don't have the bandwidth to do this. We all have real lives, right? Myself included. So if you've got a good advisor who already does that for you, great, stick with them. But if you don't, or you'd like a second opinion of one who does, talk to one of the endorsed advisors that Wealthion recommends, perhaps even John and Mike and their team there at New Harbor Financial. They'll give you a free consultation, doesn't cost you anything, no commitment to work with them. It's just a public service they offer to help make folks smarter and better prepared. To set up one of those free consultations, just go to wealthion.com, fill out the short form there. All right, guys, getting pretty interesting in the markets here. Definitely feeling a little bit toppy, but who knows? Regardless, whatever the markets do, we'll see it and break it down for folks here together next week. Folks watching, if you have enjoyed having Tom on the program, want to see him and other great minds like him back, please support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. John and Mike, guys, thanks again for a great week. Everybody else, thanks so much for watching.
Thank you, Adam. Really enjoyed it this week.
Have a good day, Adam. Thanks.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry. The market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.